So let me introduce my own presentation. I have been, as you might know, governor of Banque de France during 10 years, and then during 8 years, president of the ECB. So that makes 18 years of being a central banker. So try to take stock of this central banking I would not say episode, but central banking long-standing position to try to understand better where we stand. And of course, the present moment is interesting because we lived successive periods that were extremely different. We had a period where we were in a, I would say, more or less a normal period, but nevertheless, full of challenges, of course. I would say from the beginning of the century up to Lehman Brothers. Then we had this dramatic crisis, which was absolutely unforeseen and was very, very tough, I have to say, for all the decision makers. And then after this great financial crisis, we had, this is the wind. Okay. So the tempest is still there. It is a metaphor of all the tempest we have in the world today. So there was a period which we did not experience since World War II of very, very low inflation with a threat of deflation. And as usual, it's not a criticism against the economists, but when we are experiencing a period either of low inflation or high inflation or whatever, or calm period, then there is a tendency for mainstream economists to say, well, now it's the roux, it's the new way of thinking. So when we had very low inflation, it went without saying, in the eyes of many, unfortunately they were wrong, that we would eternally have very, very low inflation, and we had to take that into account, and the interest rates would be also extraordinarily low and so forth. It proved wrong, and in the more recent period, say in the mid of the COVID episode, we had the inflation back. And that was a dramatic difference between the period of extremely low inflation and threat of deflation and materialization of the deflationary risk, and the period where we had inflation back. We are still a little bit in this period of inflation being more or less back, despite the fact that the central banks did their job, in my opinion, very well. I have to say that to take a number of big economies, in the advanced part of the economies, inflation is still there, not dramatic, still there in the US. It is frankly practically out of the picture now in Europe. And you have countries where you still have inflation in the advanced economy, and also all over the world, but you know better because you're coming from the rest of the world, from all over the world. We have countries where we still have episodes of inflation, even if I have to say the developing world was, in the most recent period of time, say over the last 20 years, very well managed, I have to say, in comparison with what had happened before. But let me turn now to a number of factors I consider relatively important. And first, I would like to try to explain why, but very rapidly. I will only consider all what I will say now as titles of chapters. Then we could elaborate, of course, in the question and answers, but I have no sufficient time to elaborate too much. But title of chapters. Why were we in a situation where inflation looked as having really disappeared? Why was this, I would say, new way of thinking to monetary policy and to inflation by the mainstream economist, considering that we were really out of an inflation danger. So it started, as I told you, after the great financial crisis. And one of the reasons was certainly, I will list 5 main reasons, and you probably will find others. I don't pretend to be exhaustive. But you had the scars, of course, of the global financial crisis, which substantially lowered economic growth in the advanced economies. I will very much concentrate on advanced economy as a whole, on both sides of the Atlantic, say, to oversimplify. And so economic growth was much lower than the previous economic growth, potential growth. And output gaps were negative in this respect, therefore pushing down inflation. These negative output gaps remained even when we take into account the downward revision to potential growth over the period, which was due to the slowing down of productivity growth. This is a very important point. Productivity growth has been put down largely in the moment of the great financial crisis, and the, I would say, question on whether or not it will stay there or whether or not we will be in a totally different universe from now on is a very important question. We could address that question in the question and answers. So first, the scars of the great financial crisis. Second, we have to take into account the acceleration of globalization. Globalization was there, of course, before the great financial crisis, but there were a period of formidable acceleration of globalization after the global financial crisis. So I don't insist on that. You know better than anybody how it was, I would say, operated. Manufacturers perfected the international value chains that enabled them to have the lowest level of production costs. China playing a very important role, but the rest of emerging the emerging world, and of course this acceleration of globalization has contributed massively to the lower, I would say, inflation in that period. A third reason, which is also very important and appears to be extremely important politically, was that the bargaining power of the labor in a lot of advanced economy was, I would say, formidably weakened in the period for a number of reasons. In the United States in particular, there was abnormally low growth of nominal and real wages and salaries, and it was obvious, it was a major, I would say, phenomenon that was considered extremely important by economists in general to try to explain why you had such a low level of nominal and real wages and salaries, to the extent, of course, that inflation is closely correlated with changes in unit production costs, namely the result of combining productivity gains on the one hand and nominal wage increases on the other hand. The fact that the nominal wage increases, as I said, and real wage increases were very low, of course, contributed massively to low inflation. I will go back to that because President Trump, the very existence of President Trump shows what are the political consequences of this period where the weakening of bargaining power of labor was obvious. A fourth factor, which is also extremely important and was very well documented by economists, was the savings glut. Savings glut, namely excess of savings at the global level in comparison with investment at the global level, which was, of course, explaining both, I would say, low interest rates, low real and nominal and real interest rates on the one hand, and also very low inflation by virtue of low aggregate demand relative to potential supply. at the global level. So this, in my opinion, was also part of the, I would say, very low inflation episode that we have known, again, from the great financial crisis up to mid the episode, the midpoint, the episode of the COVID. And there is, in my opinion, 5 reasons which was, I would say, augmenting, of course, the danger associated with very low inflation, which was the COVID. The COVID itself was in, I would say, putting a fantastic, I would say, tendency to slow down the growth, the production, and also consumption, created a period where we had extremely low inflation with a constant threat of synchronized implosion of supply and demand, I would say, in all economies, which were depending on this incredible COVID episode. So, all taken into account, the COVID episode was at the end of the period. As you see, it's much more conjunctural. But the 4 first reasons I mentioned were, in my opinion, really very, very, I would say, serious, had to be taken into account, were a major factor to explain very low inflation. And as a matter of result of this period, of course, in the eyes of the central banks on the one hand, but also in the eyes of responsible persons, responsible entities, executive branches, and so forth, the idea that the main danger was really the danger of materialization of deflation with this very abnormal and unseen episode of low inflation was the main problem. And rightly so, obviously. I don't dispute for 1 second the fact that had we had materialization of deflation, we would have been, without COVID, if I may, in some kind of implosion of the overall economies concerned, namely mainly the advanced economy, but the rest of the world would be also in exactly the same spiraling down, which is very dramatic. And so it was very normal and very responsible from the part of the major central banks to combat this materialization of deflation, therefore to have policies, monetary policies, that were extremely accommodating. That was generalized, as you might remember, with inflation at 0 level in the Anglo-Saxon world, inflation even negative, interest rates at 0 level for the English-speaking world, interest rates at negative level in Japan, in the European area, and in the Eurozone. And all this, of course, was something which was noted as also totally new. There was no real, I would say, interest rates so low in the memory. There was certainly no negative nominal rates since World War II. So we were in a universe which was considered, rightly so, as totally new and highly dangerous, obviously. There was a lot of criticism of excess of accommodation by central banks in general, but all taken into account, it is not reasonable, in my opinion, to, from now on, to make a dramatic criticism of the monetary policy that were pursued at that time. Myself, I was at a moment where I left the ECB. I was not in a universe where the materialization of the deflationary risk was the main problem. I had to cope with the crisis itself, taking into account the danger of the crisis, I had to embark on unconventional measures, in particular purchase of treasury securities in a number of countries, to, again, in my vocabulary, to combat the danger that the crisis was creating in terms of, I would say, transmission of the monetary policy decisions. So I was intervening in Greece, Ireland, Portugal, Spain, and Italy with this idea. We must maintain a correct transmission of our monetary policy in the euro area. But I was not embarking on massive quantitative easing with a view, and other measures of that kind, with a view to avoid the, I would say, materialization of the deflationary risk. I don't mean that it was easy in my period, to cope with the financial crisis. And you might remember at the time we had 5 countries, I mentioned the 5, by the way, a moment ago, that were in a very dramatic situation and were threatened to be themselves in a totally dramatic situation. So it was difficult, but it was only part, if I may, of the euro area. It was not the totality of the euro area. The part of the euro area which was threatened by this attack, quote unquote, of speculators represented approximately between 35% and 40% of the GDP of the area itself. Alors, that was for the period of very low inflation, deflationary risk being the major problem. Now, inflation went back, and that was a great surprise for many, in particular, I have to say, for many economists, because they thought all the reasons I have already mentioned to explain very low inflation during a long period of time, until the COVID, from the great financial crisis, they had a difficulty to imagine that we could be in a totally different universe. So they had a tendency to consider all the reasons, and they were numerous. You remember the 4 reasons I have mentioned, the fifth reason being the COVID. They had in mind that it was very likely that those reasons would still be there. So I will try to explain why they were wrong, obviously, which was proved by facts and figures, and why there was many causes for the return of inflation. So I would say again, give you titles of chapters. First, the post-COVID recovery itself, which happened, say, mid-21, something like that. You might have it's very close. I mean, you experience, all of us experience this period. So after the very, very dramatic period where both supply and demand were on their way to shrink and to totally shrink and create something which was really dramatic and that we all had to combat, we were in a period where the success of the fight against the COVID created the possibility of reopening both, I would say, supply and demand. And in this period of reopening of supply and demand manifested its presence immediately for many reasons. First of all, getting out of a period where everything was constrained for demand was a formidable relief. You had also the money which the various, I would say, entities had, because to combat the dramatic episode of COVID, a lot of money had been circulated, particularly, I would say, in the direction of the households, but not only the households. A lot of firms were benefiting from all the factors that were in terms of fiscal contribution coming from the various countries. So you had a lot of money you had a lot of money and the possibility of spending that money. On the other hand, you had the scars of the COVID period, which were still there in terms of production. So you had a textbook, I would say, episode, which was very, very simple to explain, demand jumping up, and supply being still very difficult to meet the demand. So the mismatch between strong demand and insufficient supply of goods and services, I date it from the period first half of 21. In the US, a little bit earlier than in Europe. But on both sides of the Atlantic, you had the same phenomenon. So at least I have the trigger. I have the trigger for the restart of inflation. A trigger of that kind was not necessarily considered as decisive, and it did not prevent until the end of 21 the central bankers, and in particular on both sides of the Atlantic, including Jay Powell, to say, well, maybe we have inflation, it's obvious, but it is transitory, it will not last, it is only an episode which we can explain because of the conjuncture in which we are. The change of the rhetoric on both sides of the Atlantic, but mainly in the US, came at the beginning of November. Since the start of inflation up to beginning of November, we had this idea that this was transitory. Anyway, first reason, we had a trigger. Second reason, clearly, we had a difficulty at the level of the central bankers, but I already mentioned that because I mentioned the difference between the start of the phenomenon in the first half of 21 and the recognition that there was something serious which came only in November and December of the same year. So the moment when the central bank in the US said it's not only transitory, it looks like sustainable and sticky in the medium term. So you see, there was a great difficulty to accept that we had changed, the universe had changed. It's clear that it was extremely difficult for the central bankers and also for the governments to go against what had been very, I would say, considered mainstream by economists, namely now inflation is very low and for a long period of time, and also to go against the market. The market was absolutely convinced also, so mainstream economists, market, and it was also, by the way, difficult for the executive branches to themselves augment the sentiment of the population that there was a real inflationary risk. So we can explain very well why there was no immediate response at all, why they had waited too long. It is a second reason for inflation to have been not only to start, but also to have been sustainable, sticky, as I said. A third reason, and the fourth reasons, I go very rapidly on that, was that monetary policy had been accommodating during a very, very long period of time, say a decade, in the advanced economies, and also in a number of other economies the world over, when they had the possibility of doing that. And so we had a considerable stock of central bank money, or base money, that was accumulating in the economies of advanced economies. Again, I'm concentrating on both sides of the Atlantic. And so we had, at the moment where inflation was back there, an enormous capacity of mobilizing, in particular by commercial banks, which had enormous reserves in the accounts of the central bank, so an enormous possibility to mobilize those reserves. And that is, of course, absolutely obvious. The trillions of dollars or trillions of euros had been accumulated during the period of extreme accommodation already mentioned. A fourth reason was the legacy of the fiscal policy, very accommodating in all advanced economies, I would say in all countries that had the capacity to have a very, I would say, accommodating fiscal policy, particularly the advanced economy, and certainly on both sides of the Atlantic. Even if inside the constituency of advanced economy, you certainly had Japan and the US on top of the others. That was there, that you had probably the most, I would say, accommodating fiscal policies. So, two reasons. The first, two reasons piling up, if I may, of accommodating monetary policy and fiscal policy. Now we have other reasons that are more of a structural nature, and you will recognize more or less, perhaps, the symmetric of what I had mentioned already as, I would say, important and systemic in terms of providing low inflation. The acceleration of globalization, already mentioned as a major factor for disinflation, had been substantially reversed. The COVID had been quite instrumental in this respect because it was emblematic of the fact that when you needed a lot of imports for masks, for medicine, for all kind of, I would say, drugs that could fight against the COVID, you were at a fantastic disadvantage. So the idea that the globalization, the very long value-added chain could not continue forever appears to be something for real and was again materialized more or less in the health risks that were obvious in the time of the COVID. Now you have also the idea that much more generalized dependency on the long value chain, global value chain I have mentioned, was something which was also very dangerous. And the risk associated with the achieved, if I may, global division of labor, associated with the sentiment that a number of economies were being extremely vulnerable, and it was particularly the case in the US, the US meditation on where do we stand now, we don't manufacture nothing, and we are totally depending on China and so forth. All this, I would say, was more or less materializing in the reasoning of the major, I would say, advanced economy. The Inflation Reduction Act, you might remember, is from 2022. So it's already a short time after the start of this phenomenon of I would say, restart of inflation. So I mentioned all that. We are living in this period. It's absolutely clear that most countries in the world, and certainly those who were the champion of the overall which were the champion of the overall globalization, realized that it could be dangerous, and they had to take that into account also. And again, it's not only words, it's not only a change in the theory, it's a change in the decision-making processes, particularly in the United States of America, but also in the rest of the world. That was the number 5, if I may reason. The number 6 reason, which also part of the structural factors, clearly what I mentioned as the blue-collar situation, which was a situation of weakening their bargaining power. It was considered during a long period of time by my friends, economists in the United States, an economic phenomenon. how is it that there is such a disadvantage for the blue collars or the low educated member of the workforce? What happens in this domain? Is it associated with the acceleration of digitalization and so forth? The fact is that it was obviously an economic phenomenon, but it was also a massive political phenomenon. And we had the demonstration of the fact, even before, I would say, the inflation phenomenon I mentioned, the simple fact that the new president of the United States was coming from the Republican constituency and not the Democrats, because he had conquered a large part of the Democratic base of blue collar. And he was the candidate of the blue collars, which was something totally different from the US tradition. In the US tradition, the Republican candidate was the representative of the big business, and the Democrats candidate was representative of the overall, I would say, union of the labor, and AFL-CIO was behind the candidate of the Democrats. So that dramatic change, which happened twice now in the United States, gives me an additional element to understand that we had something which was even far away from only an economic analysis, but which was also a political phenomenon of first magnitude. And of course, if I take seriously the fact that low inflation was part of the phenomenon of unit labor cost being maintained at a very low nominal level, which would explain the low inflation, now you see that we will see exactly what happens, because the ambiguity and the complexity of the United States in particular is obvious, and nobody knows exactly which interest President Trump is representing. But all taken into account, it's clear that there has been a very dramatic change. That was for my number 6. Number 7, we have to take into account, in my opinion, and there again we will see how the US is instrumental in this domain, the green transition. The green transition is something which is extremely important, which cannot be, I would say, neglected. Still, of course, as you know, there is a denial in the United States, at least in the present executive branch, that it should be pursued resolutely. We will see exactly how it evolves. But what is sure is that at the very beginning, there was the sentiment that it was a win-win, I would say, change of I would say, global action, global consensus, and that we would both, I would say, save the planet, help considerably our own, I would say, spaceship, planet Earth, to be in a much more healthy situation, but also that we would create more jobs, that we would create more, I would say, new industry, and that we were winning on all, I would say, grounds, which was, of course, a very naive way of presenting the green transition. The green transition has a cost, of course. The cost of the green transition might be considerable, is probably considerable. The best analysis that has been made, and I have several names in my memory, are insisting on the fact that, again, it would be extremely naive to think that the green transition has no cost. Cost of the green transition means probably in the medium and long run. I don't say that it is already very visible, but it will mean in the medium and long run a totally different universe from the universe of the savings glut. The new investment necessarily to change the production processes, the obsolescence of the previous, I would say, production mechanism, and the necessity to invest, as I said, considerable amount of money will certainly change both what I said already was the savings glut, namely helping low inflation at a global level and also helping low interest rates, low real interest rates at a global level. In both cases, it seems to me that we might be in a different universe from that standpoint. Now, I said 8 causes for inflation to be more entrenched than we would like. I mentioned en passant the war in Europe. Not that I consider war in Europe something not important. It's extremely important. It's totally dramatic. And we are far away from the end of this war. It is absolutely clear that it played a very important role at the beginning in pushing up inflation because of energy and all the cost, additional cost that we are associated on energy and on food with this dramatic geostrategic episode. I note also en passant that Europe is particularly at stake. Europe is extremely vulnerable. It's war in Europe, and that war in Europe is hurting Europe more than the US and more than the rest of the world. So I mentioned that en passant, and that's the reason why I had 8 reasons. But as you see, I hope very much, and I expect that we all hope, that it will not, I would say, last forever, that it is also something which is conjunctural and not structural in the long run. So you see, I have a number of reasons why we should not, I would say, underassess the inflationary episode. I said that we were still in this episode. The last figure I can give you to, I would say, give some flesh to where we stand on both sides of the Atlantic at the present moment. We have information for the month of December in Europe. We have always information in Europe before the US. So on January 7, if I'm not misled, it was 2 days ago, we have headline inflation at the level of 2% and core inflation at the level of 2.3% in Europe. Taking into account that we have a definition of price stability, and I will go back to that, which is around 2%, of course, I can say reasonably that we are not far away from having fought inflation. When you consider that at the peak in Europe, we had an inflation of something like 11.5%. So it is a very, very serious work which has been done. And I draw your attention to the fact that the only, I would say, previous episode of that kind we had was the first and second oil shock in 73 and 80. And there, the benign neglect of the central bank was absolutely dramatic. They did nothing, at least in the US, and only, I have to say, sadly, only Switzerland and Germany proved able to take decisions that were very courageous at the time. I'm speaking of the central banks. And of course, they did not solve the inflation problems for them, but they helped considerably to fight against inflation in their own country. But in the rest of the world and in the rest of the advanced economies, we had very, very high inflation, entrenched inflation during a long period of time. And when I compare what has been done since mid-81 in the world with what had been done since, I would say, 73 and the first oil shock before, there is an enormous difference, and we can congratulate, it seems to me, the central bank from having been able to redress the situation. I mentioned the figures for Europe. For the US, we have only the figure of November. We will have later on, it seems to me, the figure of for December later this month. Headline is at 2.7 in the US and core at 2.6. You see, there is not an enormous difference between the US and Europe. And I will explain that very well because there had been very tough decisions taken on both sides of the Atlantic in terms of interest rates. Still, of course, you have inflation still there in the United States of America, taking into account the fact that their definition of price stability is also 2% as it is in Europe, and by the way, as it is in a number of other major advanced economies. So let me tell you why it seems to me that I'm regularly looking at the time. You give me 10 minutes more? Okay, that's extremely generous. So, well, I will go very rapidly on. But I don't know whether the paper I am more or less commenting had been circulated. Yeah, so I can go even much faster then. Why is it that it was so difficult? I already mentioned that, so I don't insist on that. I think that we had certainly a difficulty to understand what was happening, okay? We had the sentiment that after all, things could continue forever as it were before, okay? There was also a very important element which was associated with the period of extremely accommodating policies, which was the forward guidance and the fact that central banks thought it was very clever to embark in advance in telling I would say, market participants, whatever happens, we will continue to do this and that, which is extremely accommodating. And that of course, was hampering their own action. And I have to mention something which is particularly interesting for those of us who have the intention to be economists. The models, the neo-Keynesian dynamic stochastic general equilibrium model, have a lot of drawbacks. And we have to beware from these models, which would say are dominant still at the moment I'm speaking, and explain why it was so difficult to get out of the sentiment that all this was transitory. Now, let me explain why it seems to me that I can be reasonably optimistic in terms of our capacity to regain control of inflation. As I said, we have largely regained control of inflation. So what I mentioned as optimism was perhaps more appropriate 1 or 2 years ago. But let me say that we had a great determination, and this is very important, from the central banks. The Fed raised interest rates 11 times. If you had asked economists and market participants, and I would say public opinion, whether it was thinkable that the Fed could raise interest rates 11 times successively, if you had asked that at the beginning of the year, I would say 20 or beginning of 21, the response would have said, no way, absolutely unthinkable. But facing the inflation, the US central banks took those decisions 11 times. And the determination of the ECB was the same. The ECB raised interest rates 10 times between July 22 and September 23, so during a short period of time. So strong determination of the central banks, unprecedented rapid increase of interest rates, followed by the decrease of interest rates to accompany the disinflation. And as you know, as regards interest rates, Europe is at 2% at the moment I'm speaking, so more or less at the level of the precise objective in terms of inflation. And all, I would say, information we have are that the European Central Bank is reasonably confident that with 2% maintained, unless there are new elements which might change any time, but normally they would consolidate the sentiment they have that now they are more or less in the medium run at the level which was their goal. So it's a little bit more complicated in the US, and to be frank, terribly more complicated, because all the reasoning I had was on the basis of an independent central bank, of a Federal Reserve continuing to be largely independent, of course, depending on the public opinion, depending on the will of the public opinion, not to be in a situation where they would have to live with a high level of inflation, but totally independent from the executive branch. With the present executive branch in the United States, it is not a working assumption that it seems to me we can do now. So it's very likely that when Jay Powell not resigns, but is at the end of his term, he will be replaced by somebody who will be extremely accommodating, certainly accommodating vis-à-vis the US president. And any change in the membership of the Open Market Committee might, of course, also contribute to change the policy of the central bank. So we are, and this is the interest of this, I would say, of the debate afterwards, we are at a turning point. I was myself extremely happy to see that we had crystallized a sentiment in the major central banks that we could fight together and maintain together price stability around 2% with a very large level of consensus the world over, and certainly the consensus of all the central banks that were issuing currencies that are in the basket of the SDR. So this was something new, extremely important, extremely interesting, and which is, in terms of systemic, I would say, behavior of central banks, was absolutely new and remarkable. Now we have to be much more prudent and cautious. It's not excluded that the executive branch in the US will force the Federal Reserve to depart from its present position, which was to be also totally in favor of a definition of price stability around 2%. So let me conclude. There are other reasons why I was optimistic until now, until the emergence of the possibility of for Trump to manipulate the Central Bank of the United States. But let me nevertheless mention that even if there is the destruction of the present consensus, the simple fact that we could have a consensus of all major central banks of the advanced economy issuing currencies that are in the basket of the SDR, namely the dollar, the euro, the yen, and the sterling. You know, in the basket of the SDR, you have 5 currencies. The 4 currencies of advanced economy I have already mentioned, which are all important currencies, totally convertible. And then you have also the renminbi, the Chinese currency, which is the 5th. So you have 5 currencies that are in the basket of the SDR. For the first time since the explosion of Bretton Woods, you remember Bretton Woods, every currency is aligned or has to respect some kind of relationship with the US dollar. And the US dollar is to be converted in gold if necessary. So that was the rule. Now we had the explosion, we have the generalized floating of currencies, But at the present moment, and this is extremely important, this was perhaps extremely important if unfortunately it explodes, but the nominal anchor today of the international monetary system exists. There is a nominal anchor. It's not the dollar, it's not the gold, it is 2%. 2% as the definition of price stability in all, I would say, the economies. Very important because they issue the fully convertible currencies of the world. The main problem there is the renminbi, which is not fully convertible at the present moment. It will be. The renminbi will be fully convertible, but it is not at the present moment. And in any case, I would say that the renminbi today is a currency which is experiencing a very, very low level of inflation. So it's not contradicting the 2%, the consensus on the 2% of the 4 other major central banks. That, I would say, my memory is that we probably have inflation in China, but some of you might know better, something like maybe 1%, maybe a little bit lower than 1 or higher than 1, but it is fully in line, if I may, at the moment I'm speaking, with the definition of price stability, which is the consensus of all the other central banks I have been mentioning. So I can go much more and elaborate much more on this, I would say, episode in the international monetary system, which I consider extremely important, and I could perhaps elaborate more also on all the successive decisions that were instrumental in this respect. I thank you very much for your attention.